Tuesday, the 5th of September, European stocks drift lower. The Chinese PMI data has been a drag all day, to be honest. One sector that stands out on the upside, we'll talk about what is driving it, is the energy sector. Crude is higher. We'll talk about why in just a moment. That's the picture in Europe. The details today really matter. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
European stocks drifting lower a little bit. Since the get-go this morning, the Chinese PMI data, the weakness we've seen there, certainly acting as a little bit of a brake on any forward momentum this market may have. So we're down by around 0.2%. The Chinese data represented here by Kering, down by 2.25%. The luxury sector, anything with significant exposure to China, particularly on the services side, particularly on the consumer side, has been weaker today. The area that has seen some strength has been energy. Unsurprising. Look at what is happening with Brent. We're up by 0.9%. We're trading around 90. Went through it a little bit earlier on. The Russians and the Saudis are going to continue their cuts, not for a month, but until the end of the year, Alex.
Honestly, I'm surprised the market was surprised that was going to happen. But anyway, to your point, S&P 500 is just off by 1/10. But I did want to point out S&P Energy Index. We had seen a much more powerful rally earlier when those headlines crossed. We were fading it a little bit, yet still eking out a gain of 0.6. Hey, we'll take it. It's one of the only sectors up in the green today in the S&P. What is really interesting that's evolving here is that persistently stronger dollar. The Bloomberg Dollar Index at the highest level since March. So just that persistent stronger dollar. Is it a U.S. economy? Where are we in that smile? We'll talk about that in just a moment. 10-year yield popping about 7 basis points. Is that good value now? If we have questions about, say, the economy, recession, wage price spiral, higher oil prices leading to more inflation, a kick back up, tough comps, I mean, are we appropriately priced along the curve, Guy?
It's a tricky question. ECB next week, Fed goes into a quiet period this week. The data are going to matter. It's really tricky at this point to call what is going to happen next. Let's talk about what is happening in Munich right now as well. I want to talk about what is going on with the car sector here in Europe. Today we're seeing strength in the energy sector, but for a long time now we've seen significant weakness in the European auto sector. And we talk about this at a time when the global auto industry is gathered in Munich for the conference that is taking place there, the show that is taking place there. And it's really interesting. The Chinese are there and in scale and in size. And it feels like the Europeans are very much on the back foot. And you can see that represented in what we're seeing in the valuations with this car sector at the moment. The European car sector actually this year hasn't been too bad. But this sector is so cheap right now versus not only the European market, but the US market as well, that it really is eye-watering. As somebody wrote this morning, Michael Masika, on the Bloomberg terminal, these stocks are priced to fail. They are priced to go out of business. Is that really going to happen? Car makers are the cheapest sector in Europe, and it's been basically going on for 2 years right now, Alex. What is going to change that? Is the situation going to get any easier? The US car makers are protected by Joe Biden's IRA. The Europeans don't have that benefit.
No, they don't. I mean, on the flip side, though, you definitely have the downsides to the IRA, which is what we're seeing with the potential auto strike in the next few weeks. But to your point, China automaker BYD was also at the auto show. The company's managing director for Europe, Michael Hsu, spoke with Bloomberg's Oliver Crook at the IAA Mobility Show earlier in Munich.
We've got a very good marketing performance in China. Europe is our strategic market. And we want to communicate with the customer here. And let's see, the IAA is a great opportunity and to have this conversation. We love to be here and to hope every customer in Europe can visit our booth in Munich.
Takes us to our question of the day. Why is the auto sector, from an investment point of view, running on empty right now? And what could potentially change that? Joining us from the conference, from the IAA in Munich, is Bloomberg's Oliver Crook. Our Detroit bureau chief, David Wells, joining us on the US side of this story, the labor strike story, and what is going to happen there. Ollie, I'm going to turn to you first of all in Munich. The Chinese are there, and they are there in scale. The Europeans feel really exposed right now to that threat in the way that the US car makers are not. How seriously concerned are they about that threat that is coming from China? I remember talking, and I talked about this in the last hour, to Sergio Marchionne. He told me the biggest mistake that Europe ever made was letting the Koreans in. Are we going to see the same threat being posed by the Chinese?
Well, Guy, listen, let me try to describe a scene to you, because I think this is really the allegory for what's going on, and it's going to do a lot better than me telling you all of the details. In the center of Munich right now, which is basically the motor city of Germany that has surrendered itself to the IAA, you have stands all over the place. You have a huge spread for Volkswagen sitting there. Right across from them is BYD with a huge stand, right? This is the company, BYD, that has toppled Volkswagen in China, and it is now coming for the international market and really showing itself out there. You see the ads running there. They literally say, we're BYD. You've probably never heard of us, but we're one of the biggest new energy vehicle companies in the world. So the question has been, they've conquered the Chinese market. When are they going international? What's so interesting is it's right now. I spoke to so many executives, Chinese executives, some of them whose cars are on their way literally right now to Europe.
Yeah, well, hence the valuation. Well, help me understand this, David, because here I feel like the U.S. automakers worry about Tesla all the time instead, and price cutting on Tesla, not necessarily about China.
That's right. No one really sees the U.S. market as low-hanging fruit for the Chinese. They could certainly come here. BYD is always an offshore threat who could come to the U.S. But if you're going to sell electric vehicles here, because of the Inflation Reduction Act, you have to build them here. You have to build the batteries here. That's a lot of capital investment. And if you're going to export them, Trump had started a trade war with the Chinese. Tariffs are much higher. So there's no easy, quick, cheap way into this market for the Chinese. They probably would, honestly. The way things are now with IRA, they'd have to invest a lot of money to build plants, build battery factories, get their minerals from trade partners besides China. It's just a lot of heavy lifting for them to get to this market.
David, there is a rest of the world, though. Is the U.S. car market big enough to support the U.S. car makers? Because the rest of the world is going to be open season, and the Chinese are coming for the rest of the world. They're coming for Europe. They're coming for the rest of the world. Can the U.S. car makers survive on the U.S. car market alone? And isn't there a danger that if they're not competitive in the rest of the world, that's all they're going to get?
There is, and you're already kind of seeing it. Ford doesn't do very well in China, and they really never have. General Motors has been shrinking there. The only place GM is really strong, besides the U.S., is South America, and that's not a very high profit market for them. They're actually great in South America. They're huge in Brazil, but it's a couple $100 million a year there. It's not a big profit center for them. They're going to have to try to hold on to China, which I think is going to be very difficult. The upside, or I guess the good side of that story, is because they own the truck and SUV markets in the United States, Ford, GM, and to a degree Stellantis, they just print money in this market. Stellantis is kind of more exposed because they're big in Europe as well, because it's really like a multinational 8-9 brand company now. Yeah. They're the ones who are going to have to fight against Chinese brands on multiple fronts.
So this is what we were trying to get at in the last hour, too, guys, is sort of, do you buy these stocks now? Oliver, obviously there are different issues with different auto companies, but it's like, how cheap can these guys really get in Europe? Like, or do you catch a falling knife?
Yeah, well, listen, I don't want to give any recommendations on buying this up. What I will say is, looking at the valuations, you really see a lot about what investors are thinking about in terms of these car companies. I mean, Volkswagen sold, 8.2 million cars last year? That is, I think, the second biggest on the planet. They are worth less than so many of the other companies. They're worth less than Mercedes, than Porsche, which is part of them, BYD. And what's interesting, you look at Ferrari, right? Ferrari sells 13,000 cars every single year. This isn't obviously a perfect comparison, but you're within less than $5 billion of market cap, Ferrari and Volkswagen.
This is really interesting. Ollie, there are two different types of car companies in Europe. There are the luxury car makers, Porsche, Ferrari, Mercedes, etc., that compete well in China. And then there's the mass market guys. Two different, completely different models. Is there a danger that the European authorities are basically not taking action like we're seeing with the United States to protect the car industry? If you want to build EVs, if you want to sell EVs here, you have to make them here. The Europeans aren't doing that because they're too worried about Porsche and these companies in China, and therefore they're not going to protect their domestic market. Are the Europeans caught between these two markets effectively?
To a certain degree, but really what we have to think about is actually these Chinese players and the guys I've talked to here, they're going to build their own manufacturing capacity here. So even if you throw up these barriers at some point, they're going to start building that capacity here if they want to get serious about this market. I mean, listen, as far as investors are concerned, they're still rewarding luxury. They're still rewarding the very high end. I mean, I think one of the biggest takeaways for the audience here at the Munich Auto Show of the reveals, you know, BMW had a concept car, so too did Mercedes. The thing people really seem to care about was the new G-Wagon from Mercedes, the Mini G, the Baby G. Ola Kaleni has kind of teased to us here. So really that high end is still holding up, but really this is the concern. And for Volkswagen, listen, the hint is in the name. It's a car for the people. Getting that mass market for EVs is a huge challenge.
Yeah. Olaf Scholz, the pirate, was at the show saying that we shouldn't be afraid of the Chinese. A, have you seen the eye patch? B, what are people saying at it? And C, is he right?
Listen, I think that the eye patch has made obviously quite a stir. It kind of shocked everyone on social media, but I have to say he really dealt with it with a lot of humor. Came out and posted a picture of himself, kind of very professional shot with the eye patch on. And there's also this sort of minor party here in Germany, the Pirate Party, which obviously found this quite funny. But yeah, I mean, they shouldn't be afraid. I mean, everyone I've spoke to, and I asked all the European CEOs, and they say, listen, we need to embrace competition, and this isn't new, et cetera, et cetera. But you go to this auto show, you see the number of brands there. There is not enough space, I don't think, for every single one of these to succeed. There are a lot of brands that I had never heard of before and a lot of startups. And even on Friday, UBS put out a note that was read kind of like a eulogy for the legacy automakers. I asked Renault about it. However, the Renault CEO, he had a good amount of humor about it. He said that the rumors of his death had been far greatly exaggerated.
Makes you feel good to be a U.S. auto company that's just dealing with potential auto worker strike? I don't know. Guys, thanks a lot. Really appreciate it. I also didn't know that he literally was wearing an eye patch. I just got this in this moment. Oliver Crook, thank you. Joining us in Munich, and Detroit Bureau Chief David Welch. Now I know why you were calling him a pirate this whole time, Guy. I literally had no idea.
Yeah, so the whole weekend on social media, there's been all kinds of jokes and things like that. Basically, Olaf Scholz with a parrot on his shoulder, and various other kind of Johnny Depp type memes going around.
This implies the guy was on social media.
He handles it well. Yeah, okay, I see these things. I don't have to respond to them, but I see them. Anyway, we're going to go back to our question of the day. Why is the auto sector running on empty? Ursula Marchioni, appropriately named, from BlackRock, joining us next.
So it's really, really hard to gauge what the labor dynamics are going to be over the longer run. We know that wages have been high and sticky. We haven't really seen a precipitous rise in wages. But broadly speaking, a combination of both higher oil prices as well as pressure on the labor markets, a very tight labor force, is going to continue to put some pressure on inflation.
Yep. Subhadra Rajappa, SocGen's head of US rate strategy, speaking to us, Alex and me, in the last hour. She was answering the question around the auto sector. Why is the sector running on empty? I'm going to come at this from a different angle now. The European auto sector in so many ways is emblematic of European stocks more broadly. Cheap for a long time, certainly versus the US, but cheap for a reason and good value. Key questions that I think still to be answered. Ursula Marchioni, BlackRock EMEA head of Markets and Portfolio Solutions, joins us now. Ursula, European stocks have been cheap for a long time relative to their US peers. That valuation gap has got more and more stretched. The auto sector, I think, is kind of really emblematic of that. From what you see in terms of the flows that you watch, is there any suggestion that money might start flowing from the United States back into Europe, from the United States back into the rest of the world?
Great to be here, Guy. Thank you for the question. And yes, I think what you're pointing towards, I think, is a trend that we've been living in throughout 2023 as we adapt to the new macro regime, so higher velocity in sectorial and industrial rotation. We've been looking at ETP flows throughout the year, and I think you've seen two very clear phases. The January to April, I would say, where cyclicals were in favor. We saw a lot of money flowing into Europe, to your question, into Japan. And so again, that element crystallized. And then moving into May up to July, exactly, to what you're pointing towards, the trend reversed. We all went back from a global ETP perspective into sectorial, secular trends. So a lot of US equity buying, selling of Europe, to move into August, which I call a buyer strike. So beyond the summer lull, we've seen really people pulling back. And I think it was a bit of a muscle memory of 2022, equity and bonds correlation breaking down, going back to a situation where bonds don't provide ballast in a portfolio.
Yeah.
And so to your question, going into year end, where to? I think it's an optimal time.
So where
dive
to
deeper.
then, Ursula? Is cheap good enough, or are there good enough reasons to say with safety?
Key question, Alex. So I think that I'll put out there a slightly different framework for us to think about the last 3 months and then preparing for 2024, and is one that relates to mega forces. So, trends such AI, aging demographic, the new banking world, and again, transition, geopolitical fragmentation. We've been used to these paradigm shifts, and we've been used about thinking how to capture them in the midterm. I think a lot of what we've seen this year is a proof in the pudding that many are starting to impact trading activity in the shorter term. So we just wrapped up earnings season. If you think about tech, if you think about European banks, the winners, I think they connect with some of those mega forces. And so as we move into year end, I think developed markets with a connection with AI will be an interesting cut to look at. And again, do you look at it as a region? Do you look at it as a sector question? But it's definitely a slightly different way to build portfolios and deliver alpha.
Are you confident that the trends that are in place now are going to be the trends that continue throughout the rest of the year?
Yes, I think these 5 elements are there and will play out, will continue to play out.
Right.
Again, other trends that we're observing that I believe will continue, emerging markets. So from an exchange traded products perspective, again, despite the August buyer strike that I refer to, we've seen over 20 billion going in at global level into emerging market equities. And this year, of the 8 months that we've seen, 5 had inflows above 10 billion. So again, on a relative term, brighter growth prospects, a completely different rate cycle, I think points to the fact that this has legs to continue. And so going into year end, these 2 for me on the equity side would be areas to watch. And then obviously we can move into fixed income, which has been another big chapter as rates have reset.
Yep.
Ursula, how much do you think that this is fundamentally driven or sentiment driven? Like, how important does sentiment then become?
So, good question. So the other point that I would make in terms of what investors have been doing here today is there's been a lot of tactical trading, Alex, and I think that's where the sentiment really comes through. The big change at strategic asset allocation level in terms of adapting to a new rate regime, adapting to some of the big tectonic shifts that I refer to is yet to occur. And I think that, again, if you look at different components of money in motion, you will see the 2 playing out. In my opinion, going into year end and into 2024, we will see the strategic part becoming predominant. And so I would focus on the fundamentals, to your question, on the elements that are actually going to drive value and performance in the mid to long term.
All right, Ursula, thanks a lot. Really appreciate it. Ursula Marchioni of BlackRock. We appreciate your time. All right, coming on to the other story of the day is oil prices. Saudis and Russia prolonging their unilateral oil supply curbs by another 3 months. Oil rallies, no surprise there. We're going to break down the details next and the feed through to inflation. This is Bloomberg.
So Brent, briefly going through 90 earlier on in the session, the reason for that, basically Saudi Arabia and Russia announcing they are going to extend their supply curbs to the end of the year, another 3 months. Alex Steele is surprised that anybody's surprised. Bloomberg's Will Kennedy, I'm sure, is totally unsurprised by this. He is the man you go to for the pulse of what is happening in the oil market. Surprised? I guess this is shock?
There is a surprise here. Everyone expected Saudi Arabia to extend by a month.
A month, yeah.
The surprise here that they're doing it until the end of the year. And, the Saudi oil minister, Prince Abdulaziz bin Salman, likes to keep the market guessing. And I think he did that today. People weren't expecting this 3-month extension. It shows the seriousness of their intent. And I think it's important that he's bringing Russia along with him, because although Russia's contribution is fairly modest, it shows that the OPEC Plus coalition remains strong politically, and that Riyadh and Moscow are working together to keep a grip of the oil market in the face of the challenges that they have.
Right, and obviously, I mean, yeah, 100%. I guess I'm surprised, again, why people were so surprised. And I'm wondering if the Saudis called the White House and said, hey, look, just so you know, like, we're going to be doing this, because there is literally, I don't see any lever the U.S. can pull to help out President Biden right now.
Well, I mean, as we've written recently, of course, you know, the White House has denied this, but I think there are a lot of people in the oil market that suspect that the US has gone a little easy on Iranian sanctions and has been quite content to see this flow of Iranian crude into the market, which is one of the reasons why prices failed to get much traction over the summer. And the Saudis have countered. They have said, well, no, we are going to keep control of the market. We're going to do what we need to do to keep the market stable and to maintain our focus on making sure that inventories stay under control and the inventories continue to decline. So will the White House be happy about today's move? Almost certainly not. It will ultimately probably lead to slightly higher pump prices, which is particularly damaging at any time, but particularly so as we go into an election year. But I think the Saudis would argue that it's a fair response to other things that have happened.
Okay, so how much higher? Because I want to take this into the inflation conversation. This is going to start bleeding into the inflation data we're going to start seeing fairly soon. Higher gas prices are a significant component. Is it higher for longer now? Is that what we should expect at the US pump?
I'm not going to forecast the price.
No.
It's not. Can we expect
if the Saudis stick to it?
I mean, we're in a more bullish situation today than we were this morning. And talking to people in the market, you know, of course, when Saudi Arabia makes a move like this, one argument might be, well, it's actually a sign that they see something in the market that they don't like, that there's some demand weakness that they think they need to get ahead of. But people look fairly confident about demand. We've had senior oil traders in Singapore this week in their annual get-together of parties and dealing. And, you know, they've been saying, you know, obviously China has a property problem, but actually demand looks fairly solid there in the rest of the world. So this doesn't look like a response to weakness. This looks like a move to assert more control and to tighten the market.
Well, Kennedy, great stuff. Thank you, as ever. Will, as ever, taking a more measured approach than maybe Alex Steele does. Alex isn't surprised. Will sees the surprise element here from the Saudis. The Saudis, to be fair, Alex, the Saudis are going to need all the money they can lay their hands on, because they're going to need to continue to pump it into the Premier League, where certainly their money is having an impact. And it's interesting, Manchester United shares today getting smashed lower. The Mail on Sunday saying that the Glazer family apparently could be considering taking the club off the market. That's the impact on the share price, as you can see. Closes next. This is Bloomberg. To be honest, I was hoping for a little bit more excitement on my first day back. European equities at a headline level going nowhere in a hurry. What has basically happened is that the Chinese data overnight has acted as a little bit of a brake on any go forward. But it's not been a big enough break to really kind of pull the market back. So the market's just kind of gone sideways today. Within that, there are some interesting sector stories. But basically, broadly, DAX is down by 0.3%, CAC's down by 0.3%, the FTSE's down by 0.2%. None of this is particularly exciting. It's not kind of telling us much about what September is going to deliver for us. Let's talk a little bit about what is happening with the session. You can kind of see the China effect first thing, the gap lower. We kind of climb a little bit, try and get out of that, but actually, to be honest, just drifting lower in the afternoon. I think the effect here is, there's a bunch of factors here. The oil story is a kind of macro headwind, and I think that probably has been representing it, but it's not been a big enough headwind. So basically, the market's just kind of gone nowhere, down by 0.2%. If that's what we get in the whole of September, that will be a result. Like historically, that's not what September normally delivers. Q4 is usually better, but September not so much. This is the picture in terms of the single stocks. Let me just run you through a few names. Orsted's been under pressure. There's been a downgrade from a ratings agency on the back of what we've seen today. So Orsted is down by 8.28. I think we've also seen a sell side down note on that stock as well. Kering is down on the China news. The luxury, anything with exposure to China today has been under pressure. So Kering's been down by 2.13, and Sectra. This is a company that does kind of healthcare, imaging, and cybersecurity, which seems like an odd combination, but there's a margin hit here that the market hasn't liked, and that stock's been marked down quite aggressively. We're going to get a drip, drip, drip. There's still companies reporting. It's kind of a drip, drip, drip over the next few days. Talking of the day ahead, let's talk about what is happening and show you what the picture looks like. Andrew Bailey is going to be testifying. We'll get his take on what is happening with the economy. The UK economy is a complete mystery. Absolute mystery at the moment. The data revisions that we're getting are so epic that, to be honest, my head is spinning and I really can't figure out what is happening here. I suspect the governor of the Bank of England is going to have to try and address that issue tomorrow. We get German factory orders as well. Keep an eye on what is happening there. Barratt Developments, what is happening in the UK housing market is interesting at the moment. The rates transmission story, I think, is fascinating. It's certainly biting. And you are going to see that, I think, reflected in Barratt. But the different house builders are actually performing differently at the moment, which is interesting because they've traded as a block. And then I think we get to what is the main event tomorrow, actually, in some ways. The Digital Markets Act deadline is going to come through. We know what the gatekeeper companies are that are going to be affected by this. We just don't understand exactly which parts of their business, we're talking about big US companies like Apple, which parts of their business are going to be affected, Alex. And I think this is going to be really fascinating. As ever, the US provides the innovation and the Europeans then regulate it. Seems to be the model. Does it work?
Yep. That's a great perspective there. We do the innovation, you guys do the regulating. See, there's stuff happening. It makes it seem so boring. Let's get more on what to expect from the EU taking on big tech. Joining us now, Bloomberg's EU competition reporter, Sam Stolten. Sam, this time tomorrow, what are we going to know? What are we going to learn?
Hello there from Brussels. And I think the idea, actually, just to respond to some of those earlier comments from the EU, is to regulate in order to innovate. At least that's what they would argue. But yes, indeed, tomorrow we are expecting the European Commission to publish a list of so-called core platform services, things like potentially Apple App Store, Apple iOS, Microsoft's LinkedIn, Microsoft's operating system, Google Search, etc., that will come under the scope of these landmark new digital antitrust rules known as the Digital Markets Act. And now what these actually do is present so-called ex-ante rules for the digital economy, a series of do's and don'ts for some of those big tech giants.
Are they going to push back, Sam? Are we going to see significant pushback from these big US companies?
Well, if you look at the history of sort of antitrust regulation from a Brussels perspective, there has been quite a combative dynamic between some of those big tech players and the European Union's antitrust regulators. Apple for one, Google for another, have been two companies that have obviously faced off against the Commission regulators and the legal services in the European Court. So yes, indeed, there are likely to be legal challenges against some of these rules coming ahead. And the first step of that would be against some of these designation decisions that the Commission will announce tomorrow.
I love how you put the whole regulate to innovate versus maybe the US, which is innovate and then maybe sometimes regulate. And you can definitely see that in terms of the energy transition too. And I'm wondering like what a win would be here for the EU, that they regulate these big guys and then like a bunch of smaller companies start up and do some cool stuff. Like what's the goal here?
Well, ultimately, that's what they want to see. They constantly use these two terms, fairness and contestability. And in the sort of economic world, the term fairness is quite a contentious one because no one actually agrees on what it means. But what the EU really wants to see, I suppose, widespread across the European economy is the emergence of a new front of European tech players that could actually one day compete on the global stage with some of those giants from Silicon Valley.
What can we extrapolate forwards to how the EU is going to deal with AI?
Well, the AI Act is obviously going through the interinstitutional process here in Brussels. There are heavy potential regulations in place there. A lot of them will target perhaps the areas that we've known the EU to focus on before, like privacy, data protection, things like that. Now, that doesn't really come into tomorrow's announcement, but of course, in the future, should AI tech become more prevalent in our lives, we could see some of those next generation artificial intelligence technologies included on the list that will face new restrictions, for example, on data sharing or on the extent to which they can access gatekeeper services.
Sam, great to catch up. Thank you very much indeed. Sam Stolten joining us out of Brussels on what we're going to learn tomorrow. European stocks done for the day. To be honest, not really very much action. I think people are drifting back clearly off holiday. Kids are going back. Maybe we'll see some more action tomorrow. The oil price story, I think, has been a real takeaway. Early action, early doors, driven by China. The afternoon session, I think, largely driven by this move that we're seeing in the oil price. The Chinese, the Russians and the Saudis supporting that price. So those are the numbers. That's where we've closed. Not much action. We're going to see volume, I suspect, picking up as the rest of the week progresses as well. Coming up, global economic weakness certainly driving investors towards the US dollar. The US dollar at a 5-month high. The buck certainly doesn't seem to have stopped just yet. Elsa Lignos, RBC Capital Markets Global Head of FX Strategy, joining Alex and me next. This is Bloomberg. This is Bloomberg Markets. You're looking live at the principal room. Coming up, Jeremy Grantham, GMO co-founder and long-term investment strategist. He's going to be on Bloomberg Wealth with David Rubenstein, Tuesday, 9 p.m. in New York. This is Bloomberg. So the Bloomberg Dollar Index hitting its highest mark in 5 months, thanks to weakness that we're seeing in the rest of the world. Joining us now to figure out whether or not the buck has actually stopped or whether it's got legs. Can we see further moves? Elsa Lignos, RBC Capital Markets Global Head of FX Strategy. Elsa, you've been quite positive on the dollar throughout this year, but can we really see further gains from here?
I think some modest further gains are certainly possible. In my mind, there are two things that are really driving the US dollar at the moment. The first is a very simple cyclical story. The US, in relative terms, still looks like it's doing better than the rest of the world, whether that's China and the weakness we saw overnight in PMIs or the euro area, and we've seen a lot of weakness in the data there. And then the second thing is the joint twin bond equity sell-off we're seeing at the moment. And when you see yields moving higher and equities moving lower at the same time, it always tends to support the US dollar.
So based on that, I'm wondering where the cracks will form. Obviously, I'm going to look at dollar yuan and what's happening in the offshore market and sort of the implications then of a stickier, stronger dollar.
Right, and I think that's certainly been on a lot of people's radar because you've had that pressure in CNH funding, that squeeze in funding in the offshore market. The PBOC has very much set out its intent with those fixes, much lower than expected fixes in dollar CNY. I think for me, though, the more interesting one to watch is dollar yen. I mean, that's been one of our key calls this year, dollar yen topside. And the market has been very much wrong-footed there. A lot of people were looking for dollar yen lower. And even though I think positioning is a bit more neutral now, there's still a lot of people thinking it kind of should be topping out around here. And if that does break high, I think that's where more pain is to come.
Okay, let's talk about the extent of that pain. The dollar is a wrecking ball that kind of works its way around the world. Where do you think, if we carry on even at this level, Elsa, where does the pain get felt?
So you can feel it in a number of different ways. You should be looking to certain emerging markets in particular. Chile is an interesting one. They did have relatively high rates. They've started cutting quite aggressively. Now, if you get to a situation where rates in Chile are at or below the Fed, why hold the Chilean peso when you can hold the US dollar? And I think that will be where you see a lot of the pain. When you think about the yield on offer in the US dollar, it'll be in some of those lower yielding emerging markets where most pain could come.
So, but so then what's the trickle down for that? Like, I appreciate that emerging markets might not have a lot of stuff to do to support their currency, but if we just take a look into the yen, for example, like supporting the yen, dealing with capital outflows like the UN, selling treasuries, like, are we going to see that sort of second, third round effect, or have we already seen it?
That's been a really interesting question. I think it was an argument being put forward earlier in the summer for potential weakness in the Treasury market, the idea that central banks would be selling their reserve holdings in order to intervene and support their currencies. But I think a lot of that perhaps is somewhat overstated, that the duration of the bonds held in order to support the currency is actually a lot shorter, that central bank reserve managers do have pools of liquidity to access. They're not necessarily going to be selling, their 10-year bonds in size in order to support. And at the same time, this isn't a huge dollar move. I mean, it's been a kind of steady grind higher all year. It's definitely caught some people out because there was this expectation that 2023 was going to be the year that the dollar would roll over and start trending lower. But at the same time, I'm not calling for huge gains for the US dollar from here. It's more a kind of a grind higher. But those hopes for dollar bears are just slipping away into the night as they come around to this idea the US is still that relative cyclical outperformer.
Elsa, in an environment where all of the major central banks are done hiking rates, how does that shake out into the FX market?
I think that's the point where we need to start thinking about the role of the level of yields, not just the yield dynamic. So when you think about an environment where central banks are going to be cutting at some point, but perhaps not as quickly as people initially thought, we're then left with the role of carry, and not just carry EM versus G10 or even EM versus EM, but we're actually seeing carry on offer within G10. And I think that's what we keep coming back to. It's not just a source of support for the US dollar, but even things like the Kiwi dollar, which have been pretty unloved this year, can actually do reasonably well against the lower yielders in G10, the likes of the Swedish krona or even the Japanese yen.
Going to Europe for a second. Why isn't the euro lower, considering all the growth implications that we've seen from the hikes that have already happened? And I appreciate that there's still hawks on the ECB, but highlighting the growth issues versus the inflation issues over the last couple of weeks. Why aren't we lower here?
That's a good question. I mean, we have come down a fair bit, right? It's not that long ago we were well above 110, kind of pushing up towards that 113 level, and now back at 107. So it's been a fairly sizable move. And, the fact that we're not lower is in part because there's definitely been that negative bias. The market is already biased short euro dollar. And there's still some question marks around whether the ECB could deliver one more hike. Now, you may question whether that's really a good thing for the currency in the face of, as you said, those growth concerns. But I think FX traders tend to look at things in quite a simple way. And, higher yields tends to be positive for the currency, even if longer term you may really question that.
Elsa, how do you trade the UK when the economic data is being revised as aggressively as it is at the moment?
I feared you might ask that. And honestly, I think people have altogether given up on the pound this year. There was a big buy earlier in the year. We were also in that camp. It hasn't really worked. And I think people are just steering clear of it at the moment because it's just very difficult. That the higher rates are biting, they're starting to bite, and you can see that feeding through in some of the data. But it's just very difficult trying to trade that in the currency. So it's probably one I'd steer clear of.
All right, Elsa, thanks a lot. Really good to see you. Elsa Linios of RBC Capital Markets. Thank you very much. Guy, did you do okay on your exchange rate on vacation?
Yeah, the pound's actually done relatively well this year. So relative to, it's been, you were getting 1-for-1 for a while, euro to sterling, and that really hurt. So it's not quite as bad as that. But yeah, no, the pound has been stronger in my memory. Okay. So yeah, it still feels quite tough. But yeah, no, it's better than it has been. Okay. I'll take it as it is.
Your flights were bad, but at least the exchange rate was okay. Fair enough. All right, this is Bloomberg.